Hi guys, I hope the last session answered all your questions which you had in your mind regarding the pandemic and the race to the vaccine. At 6:30, we have a special session coming up by the Chief Minister of Indian Capital, New Delhi, Mr. Arvind Kejriwal, and he is going to talk about making Delhi a global startup destination. So don't miss that. And coming up next is a session which you all have been waiting for. It's about cracking the funding code. Raising your first capital is extremely hard. It may take you 50 plus rejections or more before you first crack the first round of your funding. Is there a mantra to crack the funding code? The next panel will help you crack that code. I invite all of you to participate, to join in the next panel discussion and learn from the experts and probably use it at the marketplace, which we have created at TI Global Summit, where you find startup pitches, investors, incubators, mentors, and all the people that you would need to start your company. The next session, now I will announce the panelist. We have Krishna Srinivasan, the co-founder of Live Oak Ventures. Joining him is Mr. Vishesh Rajaram. He's the co-founder of Special Invest. And moderating this session is Mr. Bijul Sumaya. He's the partner, Lightspeed Ventures. Mr. Bijul, it's up to you. I transfer.
Thanks very much, Akriti. And hi, everyone. Pleasure to be with you today. And thank you, Krishna and Vishesh, for joining. Before we get started on this, let me just let each of you take a moment to introduce yourselves and perhaps specifically share the stages at which you invest so the audience can appreciate the perspectives that you bring and the experiences that you bring to this conversation. Krishna?
Sure. Been in the venture capital business for a little over 20 years. Of course, grew up in India, went to IIT Madras, came to the United States for graduate degrees. And then I started, I'm in Austin, Texas, I should say, where it is 6:30 in the morning. So moved to Austin, Texas to join a firm called Austin Ventures to invest in early stage companies in general. And then I started my own firm called Live Oak Venture Partners early part of last decade. Our strategy is to be first institutional investors, which means we invest in seed, Series A, when we start investing in a company, and then we invest for the whole life cycle of a business. But all our companies are typically headquartered here in Texas. And then they, of course, many of them have global presence beyond that. And then we invest the whole life cycle of these businesses. They're all information tech and technology enabled services businesses, where we begin as first round investors and then always are active investors, active board members through the whole life cycle of the business from inception through hopefully then getting to promised land.
Perfect. Thank you, Krishna, and thanks for starting your day early to join us. Vishesh, over to you.
Great, thank you. Happy to be here. Quick background, I've been in the venture business now for the last 15 years. I spent a decade of that at Ventures, that I managed a $150 million fund across Series A investing. I co-founded Special Invest, we're a pre-seed seed fund investing in enterprise software and frontier technologies. We've done about a dozen investments across companies building rockets, companies that are building electric planes, motorbikes, batteries. Just to give a little flavor of what we've done on the hardware side. Glad to be here.
Yep, thank you so much. And just a little bit of context. I'm a partner at Lightspeed. We're an early stage investment firm globally. We've been investing in India for the past 13 years. And typically, let's see, roughly 70% of our investments are pre-revenue, and perhaps half of those are pre-product. So, like the two of you, also very accustomed to investing early, and really looking forward to this conversation. Maybe we could just start off exploring the different financing options that are available to entrepreneurs that are getting started. Often there's this assumption that venture capital is the only source of capital. I'd love to just explore with you whether you believe that to be true, or whether there are other sources of capital. And then maybe we can just take the conversation and explore some of the pros and cons of these different sources of capital. And if I was an entrepreneur, how should I think about maybe what makes sense for my business? Because it may be that certain types of capital are best suited to certain types of businesses. So maybe to kick off, Krishna, any thoughts on first-time entrepreneur or a repeat entrepreneur, but starting out, looking for that first check? What are the different range of options that are available?
There are incredibly wide number of options, and the smarter the entrepreneur, they look to unlock, the more types of options of financing is available. As both of you know, there are such incredible businesses all over the world, and businesses have existed for eons. And our industry, venture capital industry, is such a nascent, small industry here. So the vast majority of companies get to be successful without having to go through venture capital. And so people raise money from customers, and we call it bootstrap it, raise money from their savings accounts, raise money from banks based on revenues. There's such an incredible wide gamut of capital that people look to raise to build business of scale, and a narrow sliver of them where it makes sense come to venture capital. And I think it clearly is a function of what kind of a company that people want to build, that where it ends up being a fit for the venture capital investment platforms.
Yeah, I love your reference to, in a sense, raising money from customers, and I'd love to double click on that in a moment, because I think that almost seems old fashioned, but it's incredibly powerful. So we'll come back to that. Krishna, any initial thoughts on equity versus debt? This is something I know a lot of entrepreneurs think about. Any initial thoughts on that?
It's interesting. Yes. Yeah, I think it's hard to raise debt at the early stages, but the whole life cycle of a business, including from customer-based financing or savings-based financing or friends and family, it all, it's debt from traditional institutional sources. As people say, what's your collateral for you to raise money here becomes the challenge. So as typically our experience here is that, look, when you get started, let's say it's a technology business, which is going to be a loss-making business, you get something going with a combination of customer financing, we'll talk about that in a moment, or it is your savings or friends and family, or the FFF, friends, family, and fools that invest in a business in a very early days, and you get something going. And then when you have a little bit of escape velocity, that's when you contemplate being able to go to a bank and being able to raise money, either because it's a revenue-based financing or inventory-based financing that starts to kick in after a certain point of time, is our typical experience.
Yeah, and if
I may just chime in on that, I think it's important for the founder to reflect on the predictability of business and certain amount of cash flows, because you're typically taking debt, you have an obligation to pay it back, in a set manner, and you just need to be in a business where, with a certain degree of confidence, you're in a position to honor some of those more shorter to medium term sort of payment obligations. And I think if you are in that position, then maybe things are opening up, and there's venture debt and a bunch of other options that are coming out. But as a founder, you probably have to step back and see if you're in the stage of life where you have some predictability of where your business is and what sort of cash flows you can see coming out of it.
Yeah, and usually very early on, you don't have that level of predictability, and so
Sure.
It could. Arguably, it would also put a lot of constraints on what you can do and whether you can drive real innovation with that uncertainty. So Vishesh, your thoughts? Krishna has referred to a few different types of sources of capital. Friends, family. Actually, I'd love to get your thoughts on friends and family as an option. Angel or HNIs, seed investors. What advice would you give to me as a first-time entrepreneur? Saying to you, hey, listen, I've got this great idea, but I need to raise a crore or 1 to 5 crores of capital, for me to get started.
Yeah, I think, my preference, if there is one, is to sort of go out and raise capital from the friends and family, or an investor who possibly understands the uncertainty or that is attached with the stage of business that you're in. You do a lot of pre-seed, like you said. You've looked at companies that just had business plan on paper, and there's just the standard deviation on outcomes are very high. So investors coming in, you want to take money from people who can live with that, with that lack of predictability or with that high standard deviation, right? So and if there's a way to sort of do that, that allows founders to sort of experiment very early on, because a lot of things are not very clear. You possibly need to figure out your MVP or who your customers are or whatever that is. You want money and you want people who can generally help and not be too restrictive, right? Because you're still figuring things out. So I think raising money from financial investors who understand that, or from friends and family, where it's primarily trust that's leading the transaction or the financing, then it's a lot better. Just given that some of our companies that we do are a little bit on the hardware and possibly on the innovation side, we're also seeing grants opening up, and or they could be low cost debt or debt that you possibly pay back once you monetize IP. And those could be interesting options to consider as well. Where, in other words, you're getting capital from a source that understands just how early your life cycle is and just how unpredictable it is. And if they have that tenacity to deal with it, then you're in good shape.
Yeah. What we're touching on here, though, is that any equity source of capital, right, is going to come likely with, with two things, at least. One is dilution. And the second is some element of control, perhaps not control, but some element of at least a voice. It's like having a partner in the business, right, that you are accountable to, and we'll come to that. So before we dive into that, Krishna, financing from customers, because arguably this is a way that you can avoid having either of those two. And if you can just elaborate on what you mean by financing from customers and your thoughts on whether that's something that entrepreneurs should really think about.
Yeah, I think there are pros and cons. The pro obviously is that someone's writing you a check to build something for them. So you're looking for product market fit, right? When you build a product, you want to know the market cares for it. The fact that a customer is willing to write a check for you to build a product is spectacular. And that's clear evidence that someone cares for it. The cons are to make sure you ultimately own the intellectual property that's usable across other customers. Number two is you're not building something so customized for that one customer that it's not reusable across a whole bunch of places. And number three is, look, this might work well in an enterprise setting. If you're an enterprise customer, then the size of check they might write might be relevant. But if you're more of a consumer play, for example, then one consumer, the amount of check they write might not be sufficient for you to go scale something out. So, but a lot of incredible enterprise businesses have got launched with the couple, 3, 4 customers that strung together and gotten pretty far with a combination of customer-based financing and personal savings, and then could go back and raise institutional capital from folks like us well down the life cycle of the business. I highly recommend people trying to do that.
Yeah. So, for the audience, what Krishna is referring to is the idea of essentially a pre-sale, where you get paid in advance of delivering a product. And that obviously is cash in for your business, but also evidence that someone's willing to pay. And I love that idea. As you say, it's perhaps more viable for enterprise-oriented businesses, but just something that's worth exploring. Let's move on to, as you think about equity financing, Vishesh, how should an entrepreneur think about what they should be solving for? Valuation, control, terms. What guidance would you provide to an entrepreneur on this?
Well, it's a good question. Some of these are iterative, but if I step back, I think if the single piece to sort of optimize is, are you aligned on value creation till the next milestone or till the next stop where you're going to go out and raise capital, right? and you want to make sure that that terms are not restrictive in creating that value. So I think, yeah. So I would focus on having flexibility and having the right set of terms to operate. It's possibly more important than valuation, because as the saying goes, with what percentage of the pie that you hold matters less than what the value of the pie is. So valuation is good, but I'd rather optimize on having the right partner and the right degree of influence and operating ability to go and build a business.
Yeah. So Krishna, I come to you and I say, listen, I've got an offer from some angels or HNIs to invest, let's say a couple of crores, but they're asking for 30% of the company, and they're saying that they want the right to be able to approve any important business decision that I take. What would you say to me?
What I always tell people broadly is, look, you've not raised money yet. You have not, so you own 100% of the business. This is your company. Make your trade-offs to build the company of your dreams. So at the highest level, if you feel, look, for me, I need to control this business forever, which is I respect that sentiment a lot, then go figure out how do you raise money where you give up no control at all. Maybe it's customer-based financing, maybe it's friends and family savings, whatever it is, where you end up retaining complete control. If you want to optimize for valuation, fine, go find a pocket of money which is going to be super valuation insensitive, and they might not even have a board seat, or they might not even have a say in the business. Go optimize for that, right? If you feel like you want to build a certain type of business with venture capital value add and the governance constructs that come with it, then you are going to compromise on something, but you're going to have an institutional capital available for the entire life cycle of the business. So in some sense, you control the train, you drive it the way you want to, but you are going to be on a certain path based on those decisions you make in that first round of financing. If you go down the HNI path, that the one you articulated, with that level of control, and you are going to deal with the consequences, which you said on, is it going to be restrictive or not? If you're going on the venture path, there's a certain sort of governance, and you have a certain board, construct you come up with. You're going to live with that, and that's going to be effectively setting up the mold for the way the future of the business is going to be. So think about what's important to you in terms of control, valuation, the type of firm that you want to engage with, and that's going to set the pattern for the rest of the course of this company.
Yeah, I really love that. It is such an important decision, foundational decision that will play out not just today, but in the future. It'll impact what can happen in the future. And what I really like about what you've brought up is this idea that there's the right type of capital for me, right? And the right type of capital for me may be different than the right type of capital for you. Vishesh, thoughts on this? And perhaps you can speak specifically to venture capital. Is venture capital necessarily the right source of capital for all entrepreneurs? And if not, in what situations should an entrepreneur think about venture capital, and where maybe is it not a fit?
Sure. I think the straight answer is venture capital is possibly not the solution for everybody. If I can give a couple of nuanced examples where possibly need venture capital. Venture capital, as I see, is essentially capital that does not have a short-term return expectation. It's clearly a medium to long-term expectation, which means you're able to utilize this capital to go out and build and create value. So if you take for example, we've invested in a company that's building a rocket to take satellites to space. It's going to be a good 3.5 years before they do the first launch from get-go. All right. This is classically a company that needs capital to go out and build. And of course, there are interim milestones that you could validate technical efficacy, customer acceptance. But from when you see cash in the bank, so you're a good 2-3 years away. And this is classically a company. Yeah, this is classically a company that you need external capital, not necessarily something. Of course, you could still go get NRE money if you were doing something else from in the hardware space and still finance your way through. But these are the kind of companies that really need a little bit of external capital. The other example would be companies that need scale to show scale or patterns to show customer needs, right? You've got companies that you guys have gone and invested in, built new categories that haven't existed before. And when you want to go build out a new category, you have to go and stay in the category for some time to build it out. And in those situations, you really need capital, because you need capital to not only build the product, but sometimes even create or operate the market.
So high uncertainty, perhaps long investment cycles, significant financing risk, and I'm going to throw this in, but what kind of actually, I'm going to ask Krishna, what kind of crazy person wants to show up with capital for something like that? High uncertainty,
Exactly.
Low, significant financing risk, long gestation period. Now, the reality is there are those people, but what are you looking for in return? What do you
exactly right.
hear from an entrepreneur for you to get excited?
Yeah, so you're looking for, well, there is a special breed of an entrepreneur, but before we get into the type of a human being there, I think you're looking for large markets. Fundamentally, there are amazing businesses, which are local businesses, which are very profitable, services businesses, etc. You're looking for the combination of a business that's got large market opportunities, so that you can put up with all of that stuff with this long-term losses, long time to get to revenues or to profitability. But what's the pot of gold at the end of the rainbow here, right? You require large markets that you can be disruptive, you can build a category leaders, and there is some conviction that you can be a big business. Number two is you're looking for interesting operating leverage in the business, which is as this business keeps clicking forward and adds more and more revenues, the unit economics of the business, the gross margins, the contribution margins are going to get better over time, sort of a business. And so you're looking for businesses where there are such efficiencies that come in. And those are the kind of businesses that are a good fit with venture capital. And you overlay the nature of business, and then you want a certain breed of founder that you're looking to back who can go fulfill those dreams. That's what makes the right combination.
And so, really interesting, right? You talked about the pot of gold that might be there at the end. So the size of the prize. How important is that in the venture capitalist evaluation, Krishna? And then, I'd love to, Vishesh, for you to then perhaps talk a little bit about, therefore, how important the ability to capture the investor's imagination is for an entrepreneur. The narrative, the storytelling. But Krishna, how important is this aspect? If our audience is thinking about raising venture capital, being able to articulate what this can be, how important is that?
I think it's really, well, when people are putting up monies, and depending on the firm you're trying to go to, some firms might have a model where they have to put up, say, $50 million, $100 million in the life cycle of the business. You better have a large enough market opportunity where you can go seize 5% or 10% of that and have a sizable revenue business to make it worthwhile that all these investments have gone in through the life cycle of the business for it to get to a good endpoint. So in that context, the size of the investment you're looking to take needs to be cognizant of the size of the opportunity set you're going after. So it's incredibly important. A second important one is that a good neighborhood to be in the sense that it's like houses, right? You want to build a beautiful house, but you want to be in an area, a locality where that house will fetch a fantastic multiple, a fantastic price per square feet. So you want to be in good neighborhoods too in the venture universe, where that's a segment where you can have people with big currency who will pay phenomenal multiples of revenues, not multiples of EBITDA, multiples of income there. It's a segment where people are willing to pay a fantastic price for that kind of an asset. So not only is there a big pot of gold, is that good gold is something that you want to think about, and you want to be in the combination of those two things to be a good fit with venture capital.
Vishesh, painting this picture, in terms of the approach to a VC, where does this rank as important, in order of importance for an entrepreneur to be able to, in terms of cracking the funding code? How important is this as part of cracking the code? And what other things would you guide entrepreneurs to as part of cracking the funding code?
Yeah, I would think this is right on top of that list. And some of this also depends on stage of business, right? And for this audience and for this discussion, we're going to assume that this is someone that's trying to raise their first round of financing. One of the things that I'd love to hear from founders is what is that special insight that they have that they have very few people to agree on, or most people don't have, that sort of leading them to go out and build what they want to build, right? And to some degree, that's a good metric for why they want to do what they want to do, and why is that so unique or different from what most others are trying to do. And I think ability to sort of put that right up, because life is still early. There's a lot that you can put out in market sizing, business model, but you've got very little to show a lot of this in creation. Then what you want to be selling is why do you want to do what you want to do, and what's driving that intuition, or what facts do you have that are special to you that allows you to do that. I think I just value that most immensely, just given how early some of what we do is in. So being able to articulate that story on insight and insight-led opportunity or value creation that someone's looking to do is, in my mind, very, very valuable.
Yeah. So I'm gonna just pause and also just invite questions from the audience. If there are any, please send them in while we continue this discussion. So what I've heard is, being able to paint a picture of the future, right? So let's put this in the bucket of articulating a vision, right? That gets an investor excited and stokes their imagination, because at the end of the day, we're all buying into a vision of the future. All of these companies today are, if you valued them on what they were today, you would own the entire company, right? So it's really important for entrepreneurs to articulate their vision of the market they're in and their place in that market. Vishesh, you spoke about two really important things: unique insight that they bring, and then this ability to express how they can be different relative to other companies in the space. Krishna, any other points of advice, again, around how an entrepreneur should prepare for a conversation with a VC, and what folks like us may really be wanting to hone in on?
I definitely like people talking about what in their life's journey has prepared them to have this insight, and is an important aspect here. Meaning, you might be a first-time entrepreneur, or you might be a repeat entrepreneur. You might have worked in a company where you come in broadly as part of the industry, but be prepared to articulate and talk about what in the journey has led you to come up with this insight on what the opportunity is, what your special insight that Vishesh talked about is incredibly important to be able to have the conversation. Because and the second variant is the why now question. Why is this business suddenly relevant today that's not been relevant all these years? Is there a technology trend, a market trend, etc., that's trying to make this much more compelling? Would be another element of a story to articulate here.
Okay, perfect. And now, getting to a venture fund, are there any do's and don'ts? Cold call, cold email, meet someone at a Thai conference, and and try and get an intro. Any perspectives, Krishna, on best ways to kind of get a foot in the door?
Yeah, I think you all know this. We are as eager to meet enterprising entrepreneurs as much as entrepreneurs feel like they want to meet venture guys, right? It feels like so that's the adage. So one of our first amazing investments going back 2001 was a company called Spatial Wireless, and that spawned out 3 more amazing companies since then. I met the entrepreneur at a Thai conference, and that led to 4 years later a $300 million exit, which is a clearly a big number even then. And then he went and did a public company called Mavenir after that, which became a public NYC, which we backed him as a seed stage entrepreneur. So hustling to go meet good people is important. We are all as eager as you're eager to meet entrepreneurs. So we've even done things based on cold emails. Probably our hottest company in the portfolio today, and knock on wood, hopefully a public company, came out of a cold email to me. And so there is just a variety of ways to go around, but undoubtedly look for recommendations, referrals that people can connect you as well.
Yeah. Vishesh, any thoughts on this?
Yeah, I think not too different. If you do want to get to VCs, a warm introduction, someone that they know, someone that's always helpful. Of course, there are folks like us who are still very early, and and like Krishna said, one of our best performing companies is Ultraviolet, and I actually met them on LinkedIn. So
Yeah.
that's just me. But if you want to reach out to most top tier firms, it's great to have a warm introduction. But if not, cold emails are a bad idea.
Yeah,
and how about you, Vijay? How does one get hold of you all and Lightspeed in India there?
Yeah, I think a lot of what we do does tend to be areas we're looking at, and so because we don't have any business investing in an area we don't understand, so a lot of it is initiated by us. But what I will say is that where people write into us, I think it really helps if they have done a little bit of research on kind of this person I'm writing to, are they interested in my area, right? So if someone sends me a biotech business plan, it may be the best company in the world, but I won't know that. I won't be able to recognize it. And we all have bios up on websites, our body of work is there. We're on Twitter, maybe LinkedIn. So I would sort of just say that, if you are going to write to someone cold, just pick someone who is interested in the area that you're working on, because number one, it increases the probability that they'll reply, but number two, it also increases the probability that they'll recognize something in your idea that someone else may not. So that may be the only thought I would add. And Krishna, you spoke about hustle. And in the introduction, this point was made about dealing with rejection. I've been an entrepreneur, and in '98, in the .com boom, I was going up and down Sand Hill Road trying to raise money, and boy, is it a humbling experience. But what advice would you have for entrepreneurs who hear the word no? And actually, I want to expand this. You may hear no from investors, but you'll also hear no from customers, potential customers. You'll also hear no from potential people you're trying to recruit. We're going to hear a lot of no's. What would you say to entrepreneurs? There was a question on that, so I'm flagging it.
Yeah, look, we all have amazing companies that got said no to many, many times. We're raising our own funds, we get said no to many times, and it's all about persevering and finding that somebody else, especially in the venture funding business, it takes one person to say yes. So you might get 58 rejections. The 59th person says yes. You have a financing and you have the ability to go build to the next company, to the next stage of the business can be done. But also be incredible students of the rejection, as to always try to understand why people are saying no. And don't get defensive about it, but try to incorporate lessons learned from that into how you think about your business, how you tell the story about your business. Just be incredibly, the best entrepreneurs are, making iterations to their slide deck, 30, 50 times in the course of a financing, because there is that little twist, little subtle change that required to be able to articulate the market opportunity or the insight they have, or the way they think about the team. And it's really important to iterate and be very reflective about the feedback you're getting in a meeting so that you can do the next one better. So 2 dimensions: A, listen well and adapt and iterate. And number 2 is just be persevere, and things will take care of themselves.
Yeah, Vishesh, anything to add on that topic?
No, I think this, the investor conversation is just like any other customer conversation. So that insight on why you're getting a no and possibly self-reflecting on that's important. And in all honesty and humility, we get said no a dozen times every time we're on the road to raise capital. So we're not in any different position. We just have to learn to understand the customer better.
Yeah, I think if you can view these no's as as I'm always a big fan. I mean, I'm a VC, so I'm an optimist, but I'm always a big fan of looking for the silver lining. If you can look at every no as a gift, and the gift is what you can learn from it, as both of you have said, then when you get handed, the more gifts you get, the better. So 5 gifts are better than 1, and 15 are better than 5. And so, I think the more one can view it through that lens, the more enabling and empowering it could be. I think our time's up, folks. But before we go, just, if you have any parting comments on this journey of entrepreneurship, Vishesh, Krishna, that you'd like to share with the audience, just take 30 seconds each, and and then I'll hand over back to the organizers.
Sure. Entrepreneurship is an absolutely like running a marathon, right? And conserve yourself. There is the long collection of relationships that you build, all gets additive over time. And spend time wisely, spend time with your family. Don't over-index on one thing and one thing alone, and just be prepared for a long ride to build something of lasting value. Yeah,
I can chime in. Firstly, I agree to everything that Krishna said. I'd like to part by saying that, hey, funding is not the outcome of success. It's one of the things you need to scale. And like we said, not every company needs venture capital, but clearly there are some that do, and hence we have a job to do as well.
Super. Thank you both. Really enjoyed the conversation, guys, and thank you for sharing your insights here. Really enjoyed it. Over to the organizers.
Likewise, enjoyed it very much.